We all need to invest. Nobody knows what the future holds, but a typical lifetime includes some pretty major expenses. There's housing, of course, and there are weddings, funerals, operations, holidays, children's education, and cars. But most important of all, there's retirement. The average lifespan in the United States has risen to around 78.6 years. The number of Americans who are 100 years old or older hit a record in 2017 and continues to grow. People leaving work today will typically spend 20 years or more in retirement. That's a very long time to last without a regular salary. So, how should we invest? How do we give ourselves the very best chance of achieving our financial goals? At the very least, how do we ensure that we don't run out of money before we die and end up relying on loved ones or the state for financial support? Historically, the biggest investment returns have come from owning shares in companies or equities. A team from London Business School has carried out a detailed study into the performance of different asset classes around the world since 1900. It found that over the long term, shares are the runaway winner. Their findings are summarised in a book called Triumph of the Optimists.
If you plot through the history, using the work that I've done with my London Business School colleagues, Paul Marsh and Mike Staunton, where we've looked at the performance of individual stock markets. We've now got data for 23 different markets running from 1900 with data up to 2015. Some of those markets prospered on the way in a direction that was largely going upwards and onwards, although there were some setbacks. We called it Triumph of the Optimists because our view was that back in 1900, only real optimists would have poured their money into industrial and commercial common stocks, and that many risk-averse investors would have played safe with government securities. It was the optimists, the people who were not frightened, who performed very well.
So let's look at the figures for the US. According to Professor Dimpson and his team, between 1900 and the end of 2017, cash delivered an annualised real return, in other words, adjusted for the effects of inflation, of 0.8%. Bonds returned 2.0%. But stocks produced an average annual return of 6.5%. You could, if you wanted, invest all your money yourself in individual stocks. But the transaction costs incurred would be considerable. It would also be very time-consuming monitoring the performance of all the stocks in your portfolio. The vast majority of investors give their money to professional stock pickers who actively manage their money for them. Mark Hebner is a financial advisor and investment author based in California.
So active investing has to do with an investment strategy where an individual or a fund manager is trying to beat a market. I say a market because there are many different markets in this world, international, US, even bond markets. And so they try to engage in different strategies such as picking stocks, trying to time the market, trying to select managers who will do one of those things and beat the market. And lastly, trying to choose an investment style that they think will have the best return at some near-term future. In essence, it's speculation versus investing, and it's actually a very bad idea because we have mountains of evidence that says that none of those things actually work.
One of the most detailed studies of active fund performance was conducted by a team led by Professor David Blake at the Pensions Institute. Its findings show that after costs, only a tiny proportion of active managers outperform over the long term.
Well, the evidence shows, both for the UK and the US, if we're talking about mutual funds in particular, that a very small proportion, around about 1%, outperform in the long term on a risk and cost-adjusted basis. So 99% of fund managers deliver negative value added for their consumers once you take into account the fees that they charge.
Another problem active investors face is that a large proportion of funds are what are called closet trackers. In other words, although they claim to be actively managed, they broadly track the whole market. After costs, they're almost guaranteed to underperform. To beat the market, an active manager has to show conviction, but they're just as likely to be wrong as they are to be right. And just because they've been right in the past, that doesn't mean they'll continue to be right in the future. Distinguishing genuine skill from pure luck is extremely difficult.
If you put a large number of monkeys on a large number of typewriters for a large amount of time, one of them will type out to be or not to be. But you don't necessarily hire that monkey to write your next play. I mean, my work, which applies partly to the US, sometimes to the UK and also to Germany, suggests about 70% of funds are just closet trackers. So you're paying them a fee for something that you could really do yourself. About 20% your grandma could do better than them, so they actually remove value, and about 5% probably are skilled managers. But having said that, they are probably harder to find than the Higgs boson.
The findings of Professors Blake and Cuthbertson are backed up by Spivak, the S&P Index versus Active Scorecard. Spivak confirms that most managers underperform most of the time, and that persistent outperformance is extremely rare.
Period by period, year by year, we look at the top quartile of managers and we see how many of those top quartile managers were top quartile the year after, the year after, or the year after. And what we found there is, I'm afraid, bad news for the believers in the hope that the past is a guide to the future. And in fact, it's even worse than you might hope. So the chance of, historically, of a manager remaining in the top quartile for 5 consecutive years is actually quite a bit worse than the chance of getting heads 5 times in a row.
This all begs the question, why do active funds generally perform so poorly? Well, the central problem is that active management is a zero-sum game. For one manager to win, another has to lose. And because the fund industry has mushroomed in size, it's become increasingly difficult for a single manager to outperform his peers consistently.
The problem for most people, I think, is they just don't recognize, not paying attention to, how very many people there are who use the same kind of computers, have access to the same kind of staff, have Mike Bloomberg's wonderful system for gathering data and information any way you want it, use the same securities analysis and same securities research, get the same information from all the companies because regulators require it, so that they're par equal, par equal, par equal, par equal, and a whole bunch of different really important factors that 50, 40, 30 years ago really differentiated the winners from the others. But now it's not a differentiation because everybody has it.
Another question you might be asking is, why do so many investors continue to use actively managed funds in the face of all this evidence that after fees and charges, only a tiny number of them actually beat the market? One reason is that the active fund industry is extremely lucrative, and firms have huge budgets to spend on PR and advertising. Another reason is that all sorts of financial intermediaries have done very well out of active management and have therefore had little incentive to point out to investors what a poor deal they've received for many years. Thankfully for those investors, there are alternatives. Instead of paying to have their money actively managed, investors are increasingly opting to put it into index funds.
Passive investing, index funds, exchange-traded funds have been growing at a pace that has far outstripped traditional actively managed funds.
I call it smart investing, the kind of no regrets investing, where I've minimized the moving parts and I've maximized the chance of me getting the returns from capitalism which are there for the taking.